Hi, I'm Jimmy. In this video, we're looking at Disney stock, ticker symbol DIS. Our goal with this video is to try to better understand the basics of Disney's business and then see if we can come up with a fair value for Disney stock. And hopefully we can use this information to get us closer to our personal goal of achieving financial freedom. Okay, so let's dive into Disney's business. So Disney breaks their business into four main segments. Their largest segment is parks, experiences, and products. That accounted for about 37% of revenue in 2019. Clearly, this segment is where they account for their theme park revenue, plus Disney accounts for cruise lines, their National Geographic experiences, and then the products part of this particular segment accounts for the licensing of their trade names, their characters, the sale of their branded merchandise, things along those lines. So clearly, this is a massive part of their business that, frankly, this part of their business seems to have a very nice moat around it. There's very few brands around the world that I think have the clout that Disney has, especially in their branded products and characters. Okay, then their next largest segment is their media networks, which accounted for about 35% of revenue in 2019. Disney Media Networks, they operate their Disney branded channels like Disney and Disney Junior, things along those lines. They also have Freeform, FX, National Geographic. They have the ABC television network. They own 50% of A&E. Few more brands along those same lines. Most of the money in this segment is generated through advertising, affiliate fees, and the distribution of their content onto other platforms. Now, one thing that I've always found interesting about Disney as a business, or even as a brand, is how interconnected these four segments really are. I have two kids myself, and they love Disney. They watch Disney movies, they watch the Disney Channel, and then they really, because they watch all of those, they really want to go to the Disney theme parks. So I've personally always been impressed with the Disney business model, where the strength of each brand, of each business line that they have, fuel the other business lines, where there's only a few content creators out there that have a decent moat to their business. Disney is one of them. Because many of the top Disney movies, as an example, well, those Disney movies turn into theme park rides, and they obviously sell merchandise behind it. So I think that they have a very strong brand, and there's something to be said for that from an investing standpoint. So I'm guessing you can tell that I'm a fan of Disney as a business in general. Now let's finish running through the rest of these other two segments, and then we'll see if we can value Disney stock. Okay, so next up, we have their studio entertainment business, which accounted for about 16% of revenue from 2019. And this is where their Disney movies are accounted for from a revenue perspective. So things like Marvel, Pixar, Lucasfilm, and the list goes on to the amount of brand, or to the amount of movies that they ultimately create. And then this brings us to the direct-to-consumer business, which is this houses the highly anticipated Disney Plus. That's where Disney Plus now resides. In 2019, this accounted for about 13% of revenue, although this is anticipated to grow quite quickly since Disney Plus has really pushed out strong. They also have ESPN Plus. This is also where they have Hulu, which Disney owns about 67% of. So Disney Plus launched in November of 2019 in the United States and in 4 other countries. And they plan on launching in Western Europe, I believe in the spring of 2020, Eastern Europe in late 2020, and then Latin America, I believe in 2021. And I know that they launched in a few Asia-Pacific regions. They're trying to launch in a few different Asia-Pacific regions over that same time period, 2020 and 2021. So far, the Disney Plus rollout has been a very strong move for Disney. They had about 10 million people sign up on the first day. And I heard that after the first 3 months or so, there were almost 30 million people that had signed up. And this is impressive growth. And frankly, it's been causing quite a stir when it comes to their stock. So this is Disney's historical price to earnings ratio going back the past few years. And as we can see, there's a huge spike in their price to earnings ratio recently. Now, this spike is how much investors are willing to pay for each dollar of earnings per share. So in theory, if it's trading at a 30 times PE multiple, that means you're willing to pay $30 for $1 of earnings. Now, one of the reasons that investors are willing to pay more now is partially because of the growth that they're showing. Disney Plus is bringing in a new line of business and a new line of growth, and naturally, Many people are willing to pay more money for more growth. This is logical. This is expected. The second thing is that earnings per share has actually pulled back over the past year as Disney has finished up the merger with 21st Century Fox, and then they launched Disney Plus. Clearly, there's going to be costs associated with that. So in doing that, earnings per share over the past year have fallen, and many investors are willing to sit and wait for Disney stock for the long run. There's many long-term investors in this type of investment. So the fact that earnings pull back over the past year, maybe next year, is somewhat expected. They're willing to do that if they expect the pace to continue in the future years. Now, for me, I personally prefer to use a discounted cash flow valuation method. This is what that valuation method looked like. And if you're curious how to perform this type of analysis, I actually did a whole video on how to work through this. I've got an Excel template that I built. I've got links in the description below to that video, so I'm not going to really go through it here. But basically, what I did is I took analyst estimates for future free cash flow, and I discounted that by a required rate of return of 8.5%. That's been about what I've been using lately, 8.5%. Now, I know that this number can be a very subjective number. Basically, the required rate of return says that how much do I need for this return? How much of a return do I need on an annual basis for this investment to make sense? If you want less of a return, you'd be willing to pay a higher price for the stock. Higher return, you're willing to pay a lower price. Okay, simple enough. Then I used a perpetual growth rate of 2.5%. This is typically what I like to use. I'm a big fan of 2.5% here because where the perpetual growth rate is also somewhat subjective, it's not nearly as subjective as the required rate of return is. I use 2.5% because in theory, this is the expected growth rate of GDP. So I assume that at some point beyond the initial growth period, Disney will grow at 2.5% forever, and they could maintain that pace assuming they just kept up with what GDP was growing at. Now let's imagine that we thought that Disney could grow at 5% forever. We used 5% as a perpetual growth rate. Well, that seems a bit unrealistic. Do we still think GDP is only going to grow at 2 or 3%? If that's true, essentially what we're saying is that Disney would eventually become larger than the United States because at some point, if one is growing at 5% forever, the other one's growing at 2.5% forever, at some point the 5% one's going to be bigger, and that might be a bit unrealistic. Although I do love Disney, so maybe, but still, being more realistic. Either way, that math gives us an estimated fair value of the company of about $185 billion. $185 billion. Divide that by shares outstanding, we get a fair value of about $102 per share. Now, given that Disney stock is currently trading at about $140 per share, well, clearly, according to this valuation method, Disney stock seems overpriced today. Now, I actually did a video on Disney towards the end of 2018, and when I did, this is the result of that DCF calculation. So at that time, for the required rate of return, I used a weighted average cost of capital. That's what WACC stands for. And for that, I actually used a 9% required rate of return. And because I used a higher number, well, that would in theory lower the fair value of the stock. But the key difference that I want to point out here between this valuation and the current valuation is the shares outstanding. So today there's about 300 and some odd million more shares than there was back at the end of 2018. Now, this likely came out of some of the acquisitions that they've done recently, but I was curious if I adjusted the current valuation method with the old number of shares outstanding, well, we came up with a fair value of the stock of about $124 per share. So that's not too far off of my old calculation. But still, compared to today's price of $140 per share, well, I would still personally, as much of a fan of Disney stock as I am, I'm a big fan of their company in general, I'd still like to see the stock fall a bit more before we jump in for a long-term investment. Now, hypothetically, if we are okay, if we're going to hold this stock for the next 30 years, you know, Buffett has said that I'd rather buy a good stock or I'd rather buy a great company at a good price than a good company at a great price. So hypothetically, if we wanted to account for that, to me, this is one of those great companies. Personally, I'll be waiting for this stock to fall a little bit before I get involved. Where do we get involved? Well, a lot of that depends on what fair value we came up with. For me, I'd like to get it below my calculation of fair value today And I also wish that Disney paid a bit more of a dividend than they do. Right now, they have a dividend yield of slightly over 1%. And I actually did a video on where I went through my top 5 dividend stocks from their sector. They list themselves in the communication services sector. And I did a video where I went through my top 5 stocks. They're not on that list because I had a self-imposed minimum yield of 2%, and they are slightly over 1%. So I wish that they were paying slightly more of a dividend. Beyond that, I think it makes sense in my mind to wait for this one to pull back. We might have to wait for a market crash or something along those lines to get it there, but I'm hoping it happens. If it does happen, this is one of the first stocks I'm going after. Now, if you're curious what those top 5 dividend stocks are from the communication services sector, I did a video on that. There's a link here. There's a link in the description below. And I really want to thank you for sticking with me all the way to the video. Hopefully you found this interesting. Thanks, and I'll see you in the next video.